Hey, what's going on, guys? Welcome back to the channel. In today's video, we're going to be talking about 4 stocks that are all under or right around $20 with a huge amount of growth potential. And these stocks are for the high risk, high reward investors who can tolerate a little bit more risk to potentially make a lot more than they normally do on their investments. And I've said this before, but I really can't stress it enough. When you are investing in stocks that are under $20 or stocks that just have a smaller market cap, naturally, the volatility is going to increase and the price fluctuations are going to be a lot more aggressive. So just always keep your position size in mind and know that you should never have more money in an investment like this than you should in, say, an index fund or just a much larger cap stock with a lower beta. So if you are going to take a risky trade, just make sure you're doing your part to manage that risk by keeping your position size in check. So that's just something you should know before you get involved with any stock under $20. But let's get right into it and check out these 4 different stocks. All right, the first stock that I'm going to be talking about is something that I'm actually really excited for the future. This is an industry that really has an uncapped market and something that we see civilization slowly moving towards every single day. The company I'm referring to is Ouster, which is a high-performance Lidar company that officially came into the market a few weeks ago through a SPAC on March 12th. So this name is relatively new to the market and probably something that most people haven't heard about yet. The ticker symbol is OUST and it currently trades for $9.38 a share. And this whole Lidar industry really caught my attention because even though the technology has been around for a while, the rate at which it's developing and technologically advancing every single day is pretty wild. Lidar stands for light detection and ranging, and this is the form of technology that most people probably use on a daily basis without even knowing it. This is the type of ranging technology that you use in your car when you're either backing up with a rear view mirror, or if you have a car that has some form of sensor in the front where if something runs in front of your car or walks in front of it, then the car automatically stops. And this technology that is in the cars is something that's been around for a while. I'm sure you've been using it for years if you do own and drive a car, but the new and improved version that especially pertains to self-driving cars is something that is really growing at a very quick rate and is gaining a lot of attention in the market right now, especially because of companies like Tesla that are incorporating this new autopilot feature into their new models. This is also something that is starting to be incorporated in our iPhones. If you have the new iPhone 12 Pro, take it out and flip it around and look at those different camera settings. You can see it has 3 different cameras and then a small black dot on the bottom, and that is a Lidar sensor. And Ouster is working towards a way to make this type of technology not only accessible to all people around the world, but affordable. And a big advantage that Ouster has over their competitors is their product line and how many industries that they're able to impact with all of their different sensors. As of right now, they have 4 major types of sensors with over 75 unique beam configurations, which allows them to act as a big supplier for all types of businesses around the world that are looking to use different types of Lidar technology. So instead of just focusing on one niche specific industry like the auto industry, they're able to work with smart infrastructure, industrial development, auto, trucking, and robotics. So having such a large network like this is something that's going to help them continue to grow their sales and revenues over the years. And to take a look at their customer base right now, they have a few hundred customers worldwide using their sensors, but they have listed over 14,000 potential customers with the demand for their Lidar expected to total $50 billion across all of their markets by 2030. And this type of growth would be exponential and absolutely help drive their stock price much higher. So they're on a very good path right now, and compared to their competitors and other Lidar SPACs in the market, they are expected to have the highest revenue by 2025. And just in 2020, they had the second highest revenue compared to their competitors. But you also have to keep in mind that these companies have been in business and on the market much longer than Ouster has. So just based off of their current guidance, they are definitely in a great position to be a leader in this industry. And with the stock trading under $10 right now, I think there is a massive amount of upside for this company and stock moving forward. I definitely think that this type of technology has the potential to be huge in the future and really just be a part of our day-to-day lives. So if you do believe in things like self-driving cars or robots delivering your packages or working in restaurants and stuff along those lines, then I definitely recommend taking a look into this stock. All right, so the next two on the list are going to be energy and oil companies. You guys know that I am big on this energy sector right now, and companies like this have greatly been benefiting from rising oil prices, which is what we have in the market right now. The first one is Centennial Research Development, which trades under ticker symbol CDEV for just over $4 a share. Centennial is an energy company that is focused on the development of unconventional oil and natural gas in the Permian Basin. The company was formed in 2016, and one thing that I look for specifically with these small cap energy stocks is how they trade compared to the overall index. So I'll get into that in a little bit, but so far this year, this stock has had a huge run up alongside oil. Oil prices are up just over $60 a barrel, and as these prices continue to increase, it'll be bullish for Centennial. Just a few weeks ago, the stock hit a new high of $6.25 a share, but with oil prices, it has pulled back over the last 2 weeks, which does provide us with a potential buying opportunity. And here's what I was talking about when I said how I want to see how smaller cap stocks trade relative to other stocks in the industry. Right now, I have the 1-year chart of CDEV on the bottom screen and XLE, which is an ETF that tracks the energy sector, up on top. You can see how these two companies line up and how they've traded relatively in line over the same period of time. Now, one of the major differences that comes with investing in either an entire index like XLRE or a small cap stock like CDEV is their beta, or how much they move here percentage-wise when we have run-ups or pullbacks. So up here, when we look at the entire index, you can see that this stock has corrected just around 10% from its high. Then when we go down here to CDEV, you can see this stock has corrected much more, just under 30%. That also gives it a massive margin to recover. If we do see the energy sector start to pick up, the profit margin here back to its high would be around 40%. While on XLE, the profit margin is only around 11 or 12. So that's one thing I like to look for when assessing the overall risk versus reward setup. One fear that comes with investing in these cheap stocks is that they can trade all over the place, but the good thing with this setup here is that it has pretty much been trading in line with the rest of the energy sector, but as you saw, it does have more aggressive price swings, which does increase the potential reward. So if you can tolerate some swings like this and you think that oil prices will continue to rise from here, this is a cheap name that you could look at with over 40% profit margin back to its highs. All right, so that brings us to the next stock, which is in a similar position as Centennial, but for this one, we're gonna go up north a little bit and head into Canada and look at the Canadian company Suncor. The ticker symbol is SU, and the stock currently trades for $21.35 a share. And I know the video is titled Top 4 Stocks to Buy Under $20, but $21, it's close enough, so let's dive into what Suncor is. Suncor is a fully integrated energy company, meaning that it specializes in exploration and production, supply and trading, as well as products and services. So a little bit different than Centennial from a fundamental standpoint, but what you'll notice in just a little bit is that the technical setup and really just where the stocks are trading and how the price action looks on these two is fairly similar. You might not even pay very close attention to it with all of the other energy and oil companies here in the US, but they are in a good spot here for a few reasons. On the fundamental side, they are likely to report a much better quarter from Q1 of this year. And they're also setting up for a better quarter heading into Q2. Their fourth quarter from last year, which was the last one that they reported, was not very good. They did have to cut their quarterly dividend in half to 21 cents a share, but this poor performance was mostly a function of oil prices being significantly lower than they are today. But now we have seen oil prices rebounding so far this year, and OPEC coming out saying that they're going to keep oil production steady. So this puts Suncor on a much better path. And getting back to what I said earlier about where this stock stands from a technical standpoint, it is not as volatile as the last one, and we actually haven't seen as big of a correction as some other energy stocks, but this one is down 10%, which does give it a nice margin for recovery back up to $24 a share. And does the stock have to go back up towards $24 a share? No, but the margin is there, so betting on Suncor with oil prices rising is a pretty good risk-reward setup in my opinion. All right, so the last stock that we're going to be talking about is another SPAC idea in this crazy SPAC market, but this one already has a deal set and is expected to close sometime within the next few months, which will result in a ticker change. So I'll keep you guys updated on that, but That's just what happens when SPACs essentially de-SPAC. The ticker changes and it moves from the investment company over to the actual company that they're merging with. But this is a good thing because the major risk that you do run when investing in SPACs is that you don't know exactly what company they're going to look to merge with. So once they go out and actually find a deal, then all the attention turns into the company that they're actually looking to take public. So in this case, the company is Blade and the ticker symbol is EXPC, and it currently trades for $10.75 a share. And this deal in particular has a ton of hype around it. SPACs all come into the market at $10 a share, and usually the stocks don't really move much until the market catches wind of a potential deal. But when that happened with this stock, it ripped from the $10 initial share price to just under $20 at $19.88 in just a matter of a couple months. And since then, the stock has corrected and is now trading back in between the $10, $11, $12 range. But a big factor that influences SPAC price movements like this is the fact that they have a lot of momentum, especially tech momentum embedded in them. So there's a lot of exposure to just the overall NASDAQ. And when stocks like that have significant corrections, like in some that we've seen over the past few weeks, SPACs like this tend to follow that direction and get hit pretty hard. You do have to remember that a big reason for this happening is just because machines are selling the stocks a lot of the time. Especially in this case, it really doesn't have anything to do with the fundamentals behind the company. It's simply just because the rest of the market is selling off. And since these SPACs have a very high beta and a lot of momentum embedded in them as a factor exposure, they have these aggressive price swings. So if you do have a list of stocks that you like for the longer term, this is when you can get some pretty good buying opportunities. So there's a quick rundown on what happened with this stock over the past few weeks and just an explanation on why it's down so much. But now let's jump into what the company actually does and how they look to impact the market moving forward. So Blade is a technology-powered global air mobility platform that offers a cost-effective air transportation to some of the most congested ground routes in the US and abroad. Their goal is to be the future of urban air mobility, and they're even looking to adopt EVAs, which are electric vertical aircrafts, to help change the way that you travel in and out of your favorite cities. Right now, you can book a flight anywhere in the Northeast or on the West Coast, and then you can take a helicopter or jet pretty much anywhere in the world. So this is going to help solve some major issues between traveling in and out of cities on a daily basis. If you live on the East Coast like I do, you know that traveling in and out of places like New York City or from New York to Boston can really be a pain, and more importantly, it just takes a ton of time. The Blade is looking to be the solution to that problem by offering affordable and time-efficient alternatives. And in their most recent report, they also announced that revenues were up 53%, and they also launched 2 new major locations in Chicago and Westchester, New York. And this type of business will likely only increase into the summer as travel demand in and out of cities will only increase. Short-term traveling to cities like vacation destinations or beach towns for long weekends and whatnot will definitely be a major part of their business moving forward into the summer. And with all the pent-up demand, not only in just the travel industry in general, but for these different summer locations, should be huge this year, as it really just wasn't an option last year. So those are my top 4 stocks under or right around $20 a share. I definitely encourage you guys to take a closer look into some of these companies if you do see value in them. But if you did enjoy the video, hit that thumbs up and subscribe to the channel, and I will see you guys next time. Peace.